In Q1 2026, nearly 120,000 foreclosure filings hit the market. That's a 26% jump, with bank repossessions surging right alongside them. Nationally, that translates to 1 out of every 1,211 housing units receiving a filing. But look at this chart tracking U.S. foreclosures. Compared to the massive 2008 wave, 2026 barely registers as a tick. It's returning to normal after pandemic policies artificially suppressed filings. Today's massive equity cushions stop a systemic collapse in its tracks. Getting a mortgage over the last 15 years required strict proof of income and credit, creating a structural firewall against cascading defaults. The fear of a 2008-style housing crash right now is an illusion. The 2026 market is going through a healthy, expected recalibration, not a national meltdown. So if bad loans aren't crashing the market, why are these filings happening? We have to look at the kitchen table. The distress we are seeing today comes down to a brutal cost of living squeeze hitting current owners, forcing vulnerable budgets over the edge. First, municipalities are reappraising homes at post-COVID highs, resulting in massive jumps in annual property taxes. Second, homeowners' insurance premiums are surging as carriers price in climate risks and higher replacement costs, heavily compounding that monthly burden. Finally, deferred maintenance and rising material costs are driving up HOA fees, breaking the budget even for owners locked into ultra-low fixed-rate mortgages. You can see this strain clearly in the delinquency rates. Conventional loans are stable, with only about 2.75% falling behind. But FHA loans, which typically serve lower income and lower credit buyers, have spiked to a nearly 12% delinquency rate. With distress rising entirely due to these carrying costs rather than bad mortgages, you face a distinct choice. Do you hunt for physical real estate deals, or do you abandon the housing market entirely for alternative assets? If you want to stay in physical real estate, you need to understand that 2026 housing distress is highly geographic. The highest volumes of foreclosure starts are tightly concentrated in specific major metros across Texas, Florida, Indiana, and South Carolina. For an active investor, this creates a clear opportunity. You can step in with cash and acquire distressed, bank-owned inventory at a discount compared to their post-COVID price peaks. Let's plot active effort required against exposure to housing volatility. Distressed flipping lands in the top right quadrant, requiring heavy work with high housing risk. The massive trade-off? Buying here means absorbing the exact same insurance and tax burdens that pushed the previous owner into foreclosure. In states where property values have already reversed their recent gains, you are essentially trying to catch a falling knife while paying a premium just to hold the asset. Going after hotspots is only a viable play for cash-heavy investors who have the operational capacity to outpace these permanently higher carrying costs. If that active hustle sounds exhausting, it is time to step away from physical neighborhoods and look toward institutional finance and private fund structures. Your primary alternative here is private credit. Rather than lending to consumers for a house, you are lending directly to mid-sized, established companies. The appeal is straightforward. Private credit generates yields between 8 and 12%, and those returns are completely detached from whatever happens in the residential housing cycle. Similarly, you can look at infrastructure investments, funding essential assets like data centers and utilities. These provide highly stable, inflation-linked cash flows. Bringing our evaluation chart back up, we can see exactly where this institutional pivot fits. It sits entirely in the bottom left quadrant, requiring very low active effort from you, with virtually zero exposure to housing volatility. But the entry fee is steep. You must be an accredited investor to access these funds, facing significantly higher management fees. You also sacrifice liquidity. Capital committed is typically locked up and inaccessible for years. Alternative assets offer a safe haven from the chaos of volatile housing costs. To get that safety, you just have to trade away your liquidity and meet strict financial hurdles to get in the door. There is a middle ground if you want to avoid digital assets and institutional funds, but still want to own something you can touch. Investing in farmland or timberland allows you to hold physical real estate entirely free of residential renter headaches. These assets act as a natural physical hedge against inflation while generating steady, reliable income through agricultural leases or raw commodities. The trade-off is ceiling. These raw land assets offer much lower high-end growth potential compared to tech stocks or private equity buyouts. If your priority is capital preservation over aggressive yield, tangible real assets are the defensive play for 2026. Surviving the 2026 market requires turning down the volume on the national doom and gloom headlines. You need to match your specific investor profile to the correct asset class. Let's put this all together into a final decision framework by looking at this flowchart, starting with your primary goal for the year and branching out into 3 distinct paths. If you are an active cash investor, you can target Sunbelt foreclosures, but only if your operating margins are thick enough to survive the permanently elevated insurance and tax burdens. If you are a passive, accredited investor, you should pivot toward private credit and infrastructure. You will secure strong yields without the physical property headaches, provided you can tolerate the illiquidity. And if you are an everyday homebuyer, you need to stop waiting for a crash that isn't coming. Buy when the monthly payment makes sense for your personal budget. National home prices are forecast to see modest gains of 1 to 4% this year. Staying on the sidelines, hoping for a massive price collapse, is a strategy that will only punish your wallet. The 2026 market is defined by intense localized strain, not a national meltdown. Your success comes down to looking past the noise and executing a strategy matched exactly to your risk profile.